Demystifying SPLG, your guide to the SP 500 ETF. Hey everyone, and welcome to the channel. Today, we're diving deep into the world of ETFs, specifically focusing on the popular SPLG ETF, which tracks the SP 500 index. But before you click away thinking this is just another financial jargon fest, hold on. We're breaking down this ETF in an easy-to-understand way, answering all the questions you might have. What's the magic behind SPLG? How does it work, and how does it achieve its investment goals? Is it all sunshine and rainbows? We'll discuss the benefits and potential drawbacks of this passive investing approach. Liquidity, expense ratios, concentration risk. Don't worry, we'll decipher these terms and compare SPLG to other players in the SP 500 game. Adapting to the market rollercoaster. We'll explore whether SPLG can weather changing economic storms, or if you need a different strategy. So, whether you're a seasoned investor or just starting your financial journey, buckle up. This video will equip you with the knowledge to make informed decisions about SPLG and its place in your portfolio. Question 1. How does the SPLG ETF achieve its investment objective? Here's how SPLG achieves its investment objective of matching the performance of the SP 500 index, before fees and expenses. 1. Index replication. SPLG passively manages its portfolio by holding all the stocks in the SP 500 index in approximately the same proportions as their weight in the index. This means the ETF's performance will closely mimic the performance of the SP 500, capturing its overall market returns. 2. Rebalancing. The ETF periodically rebalances its portfolio to ensure the weights of each stock accurately reflect their weight in the SP 500. This helps maintain the close alignment between the ETF's performance and the index. 3. Expense ratio. While aiming to match the SP 500 performance, SPLG does incur minimal expenses associated with management and operations. These expenses, represented by the expense ratio, are deducted from the ETF's returns, meaning the actual investor return will be slightly lower than the SP 500 return. 4. Tracking error. Due to various factors like rebalancing costs and differences in liquidity, there might be a small tracking error between SPLG's performance and the SP 500. This error generally tends to be very small for efficient ETFs like SPLG. SPLG achieves its investment objective by passively replicating the holdings and weights of the SP 500 index, with periodic rebalancing and minimal expenses. However, investors should be aware of the expense ratio and potential tracking error that slightly deviate the actual returns from the pure SP 500 performance. Question 2. How is the underlying index of the SPLG ETF constructed and weighted? The underlying index of the SPLG ETF, the SP 500 index, is a market capitalization weighted index that tracks the performance of 500 leading companies listed on stock exchanges in the United States. Here's a breakdown of its construction and weighting. 1. Stock selection. The SP Dow Jones Indices Committee, which oversees the index, selects companies based on specific eligibility criteria, including market capitalization, size, O. Liquidity, ease of trading. O. Profitability. O. Industry representation. O. Company headquarters location, must be in the US. 2. Weighting. Each stock's weight in the index is based on its market capitalization, which is the product of its share price and the number of shares outstanding. Larger companies with higher market capitalizations have a bigger influence on the index's performance compared to smaller companies. The index is rebalanced quarterly to maintain the target market cap weight of each constituent company. This ensures the index continues to reflect the relative size and importance of companies in the U.S. stock market. Key characteristics of the S&P 500 weighting. Market cap driven, the index is more heavily influenced by the performance of large cap companies compared to mid cap and small cap companies. Sector diversification, the index covers various sectors of the U.S. economy, providing broad market exposure, but potentially less concentration in specific sectors compared to sector-focused ETFs. Regular rebalancing. Rebalancing helps maintain the market cap weighting and reduces the impact of stock price fluctuations on individual companies' weight in the index over time. Additional notes here. The S&P 500 is a free-float adjusted index, meaning only the shares readily available for trading by public investors are considered in the market capitalization calculation. The index construction and methodology are subject to periodic review and potential changes by the committee to ensure it remains representative of the U.S. stock market. Question 3. How does the ETF manager handle rebalancing the portfolio? The SPLG ETF, being passively managed, doesn't have a dedicated ETF manager who actively makes decisions about rebalancing. Instead, the rebalancing process for SPLG is automated and follows guidelines set by the S&P Dow Jones Indices, the entity responsible for maintaining the S&P 500 index. Here's how it works. 1. Threshold-based approach. Rebalancing typically occurs quarterly, but it can be triggered more frequently if the weight of any individual stock deviates significantly from its target weight in the S&P 500 by exceeding a predefined tolerance threshold. This threshold varies depending on the market capitalization of the stock. Smaller companies have a higher tolerance, e.g., 2%, due to their inherent higher volatility. Larger companies have a lower tolerance, e.g., 1%, as their movements can have a bigger impact on the overall index. 2. Authorized participants, APs. The actual buying and selling of securities to achieve rebalancing are executed by authorized participants, APs, specialized institutions that create and redeem ETF shares. APs use various strategies to minimize market impact and transaction costs, such as block trading, executing large trades off exchange to avoid influencing market prices significantly. Program trading, spreading trades over time and across different venues to minimize market impact. Basket trading, buying and selling multiple securities simultaneously to maintain the relative weights within the portfolio. 3. Creation and redemption. APs create or redeem ETF shares based on investor demand and rebalancing needs. When the ETF needs to buy stocks, e.g., During rebalancing, APs create new shares and purchase the underlying securities with the proceeds. Conversely, when shares are redeemed, APs sell the corresponding underlying securities, and the ETF shares are destroyed. 4. Transparency. The SP Dow Jones Indices publicly discloses information about rebalancing activity, including the dates, affected securities, and the amount of rebalancing flow. This transparency allows investors to track the index and the ETF's adherence to its stated objective. Key points to remember. 1. Rebalancing for SPLG is an automated process based on predefined rules and thresholds. 2. APs play a crucial role in executing rebalancing trades efficiently and minimizing market impact. 3. Transparent information about rebalancing activity is available for investors. Question 4. How does the ETF manage concentration risk in specific sectors or issuers? The SPLG ETF, by inherently tracking the SP 500 index, inherits both the benefits and risks associated with its construction and methodology. When it comes to concentration risk, SPLG reflects the sector and issuer weightings of the SP 500, which means it does not actively manage or mitigate this risk. Here's a breakdown. Concentration risk in SP 500. 1. Sector concentration. The SP 500 is dominated by a few key sectors, such as technology, healthcare, and consumer staples. This means the performance of the ETF can be heavily influenced by the performance of these sectors. For example, if the technology sector suffers a downturn, the ETF's returns will likely be negatively impacted. 2. Issuer concentration. While the index holds 500 companies, a relatively small number of large-cap companies hold a significant weight in the index. This means the performance of the ETF can be more susceptible to fluctuations in the stock prices of these individual companies. SPLG's approach to concentration risk here. 1. Passive management. As a passively managed ETF, SPLG does not attempt to actively manage or reduce concentration risk. It simply replicates the holdings and weights of the SP 500. 2. Diversification within the index. Despite the concentration within certain sectors and issuers, the SP 500 still provides some level of diversification across different industries and companies. This can help mitigate the impact of any single sector or issuer underperforming. Alternatives for managing concentration risk here. 1. Sector ETFs. Investors seeking to manage sector concentration can choose ETFs that focus on specific sectors they favor or avoid altogether. 2. Smart beta ETFs. These ETFs use alternative weighting methodologies to target specific factors or characteristics, potentially offering different risk-return profiles compared to cap-weighted indexes like the SP 500. 3. Actively managed ETFs. Actively managed ETFs have portfolio managers who make investment decisions based on their market outlook, potentially offering more control over sector and issuer weightings. Question 5. How does the liquidity of the SPLG ETF compare to other ETFs in the market? The liquidity of the SPLG ETF is generally considered good, but it's not the absolute leader in the SP 500 ETF space. Here's a breakdown. SPLG's liquidity. Average daily volume, ADV $2.7 billion, as of February 20, 2024. Bid-ask spread, typically tight, ranging from a few cents to a few tenths of a penny. Tracking error, very small, generally below 0.1%. Comparison to other SP 500 ETFs. SPDR SP 500 ETF, SPY the clear leader in terms of liquidity, with an ADV exceeding $30 billion, and an even tighter bid-ask spread. However, its expense ratio is slightly higher at 0.0945%. Vanguard SP 500 ETF, VOO offers slightly lower liquidity than SPY with an ADV of around $10 billion, but its expense ratio is even lower at 0.03%. iShares Core SP 500 ETF, IVV similar liquidity to VOO with an ADV of around $8 billion, and the same expense ratio of 0.03%. Overall, SPLG offers good liquidity for most investors, with tight spreads and sufficient trading volume. However, for investors prioritizing absolute maximum liquidity, SPY might be a better choice despite its slightly higher expense ratio. For investors focused on minimizing expense ratios, VOO and IVV could be attractive alternatives, with slightly lower liquidity compared to SPLG. Question 6. How does the SPLG ETF's investment strategy adapt to changing market conditions or economic outlooks? The SPLG ETF, by design, does not actively adapt its investment strategy to changing market conditions or economic outlooks. This is because it follows a passive management approach, aiming to replicate the performance of the SP 500 index as closely as possible. Here's a breakdown of the key points here. Passive management here. 1. SPLG doesn't have a dedicated portfolio manager making investment decisions based on market forecasts or economic predictions. 2. It simply holds all the stocks in the SP 500 index in the same proportions as their weight in the index, regardless of market conditions. Benefits of passive management in changing markets. 1. Low costs, no need for expensive research teams or analysts, leading to lower expense ratios compared to actively managed funds. 2. Transparency, the investment strategy is clear and predictable, aligned with the SP 500 performance. 3. Tax efficiency, less trading activity generally translates to lower capital gains distributions for investors. Drawbacks of passive management in changing markets. 1. Limited downside protection. The ETF won't adjust its holdings or weights based on potential downturns, potentially amplifying market losses. 2. Misses out on potential outperformance. The ETF won't capitalize on specific sectors or stocks expected to benefit from changing market conditions. Alternatives for adapting to market changes here. 1. Actively managed ETFs. These ETFs have portfolio managers who can make investment decisions based on their market outlook, potentially offering better returns during specific market conditions. 2. Smart beta ETFs. These ETFs use alternative weighting methodologies to target specific factors or characteristics, potentially offering different risk-return profiles than cap-weighted indexes like the SP 500. 3. Multi-asset ETFs. These ETFs combine different asset classes, stocks, bonds, commodities, into one fund, offering diversification and potentially smoother returns across different market environments. Remember, 1. SPLG offers a low-cost, transparent, and tax-efficient way to track the SP 500, but it doesn't adapt to changing market conditions. 2. Consider your investment goals, risk tolerance, and market outlook when choosing between passive and active strategies, or exploring alternative ETF options. So there you have it, folks. We've covered the major aspects of the SPLG ETF, from its inner workings to its performance in different market conditions. Remember, understanding any investment before putting your money in is crucial, and we hope this video has empowered you to do just that. If you have any further questions or specific areas you'd like to delve deeper into, leave a comment below, and we'll be happy to help. Don't forget to hit that subscribe button for more informative and engaging investment content. Until next time, happy investing.